Every December, the same questions come up. Where are interest rates headed next year? What can we expect for the housing market? And should I act today or should I maybe keep waiting? And honestly, after the last couple of crazy years that we've had, I completely understand. Everybody's looking for some kind of indication that we are headed in the right direction. But the truth is, 2026 likely won't be the year where everything gets easier. It's the year that we figure out which direction Canada is actually headed. A turning point, so to say. Because the road ahead has one of two directions that it could possibly go. Let me explain. Let's start with everybody's favorite, interest rates. In 2026, I expect that interest rates are either slightly lower or slightly higher than where we're at today, but not by much. When we take a look at the Bank of Canada, they already cut interest rates several times throughout 2025, and most economists already feel as if we're close to the floor. Provided that there's no sharp downturn in the Canadian economy, this could be as low as interest rates go. Think 5-year fixed mortgages somewhere in the low to mid 4% range. If there's a downturn in the economy, that could be the mid to high 3% range. Now, are those interest rates more manageable than the peak? Yes. But are we going back to pandemic levels? Certainly not. And that's okay, because what's important is making decisions based on where we are today, not where we were or where we hope we could be in the future. Renewals are still a really big story for 2026. We have over 1 million Canadians that are set to renew their mortgage this year from those ultra low pandemic rates of 1.5% up to 4%. It's definitely a shock. What you're going to see from these households is more budgeting, less spending, and probably putting off renovations or that extra family vacation that they were used to. It's definitely an adjustment, but it's not a crisis. You have to remember that majority of Canadians did qualify at the stress test rate at 5.25%. So while rates in the 4% are higher than what they're paying by more than double, it's not something that they haven't already proven that they can afford, provided that their income has remained the same or increased and they haven't seen their financial situation deteriorate. This will be the year where many Canadians choose to stay put. They're going to take a look at the math and refinance or readjust their mortgage so that it's more tax efficient and find a way to make everything work in today's new world at the higher interest rates that we have today. 2026 is the year that families rework the math, not walk away from it. Housing prices. This is where things get interesting. The housing market can take one of two potential paths next year, provided that there's something not wild that comes out of left field that we're not anticipating. If the economy holds, inflation stays in check, and our trade situation with the US stabilizes, what we could see is that the market bottom out in early 2026 and remain flat or end slightly up for the year. However, if tariffs take a bigger toll on our economy, we continue to see job numbers soften and we get no renegotiation of the USMCA, what we could see is a further pullback of housing prices across the nation of 5 to 10%, specifically in overpriced markets or overbuilt markets. So is 2026 the year where prices explode? Not likely, but it also may not be the end of the dip either. This is the moment where buying smart really matters. First-time buyers can breathe for the first time. Bidding wars are a thing of the past. Interest rates are within reasonable levels, and you can actually take your time to survey the market and figure out where you want to be, neighborhood, price point, and negotiate on the price, as vendors are much more open to that at this point in time. However, this situation and the market that we're in today will not last forever, and there's a lot of nuance to the market that we're in as well, with prices continuing to fluctuate, interest rates changing on a regular basis. So it's important that you're working with a professional. You understand your numbers, you understand that you may have slightly higher interest rates when you have to renew this mortgage in the future, and that you're not getting into a market where you're still buying where prices are potentially going to be dipping considerably, that we're getting a good price on our unit and we're making sure we're setting ourselves up for success. For first-time buyers, planning is everything in today's market. Let's talk about investors for a second. The days of buy anything, rent it, and refinance it later are long behind us. In 2026, cash flow matters. Rate risk is still very much present. And not every market is going to see appreciation moving forward. What I expect is that we're going to see less speculative buyers and more long-term thinkers. And that's a good thing, because a stable, rental-friendly market is what Canada needs. Real estate used to reward the people that acted fast. In 2026, it's going to reward those who plan well. If you're buying, renewing, or investing, advice is your asset. You're going to need to build a strategy that fits your life. Ensure that your mortgage is aligned with your larger goals. And last but not least, ensure that you're not just getting an interest rate, but a structure that fits your long-term cash flow, because the margin for error is smaller than it's ever been. 2026 is unlikely to be about wild swings. It's more about what kind of economy we become here in Canada. The first path, the optimistic one, finally sees Canada stabilize. Jobs come back, tariffs and trade relationships heal, and we finally see real estate stabilize. The other path, tariffs continue to stick. We see further job loss, and real estate is going to continue to dip before it bounces. The truth is, we're not waiting for some kind of miracle. But either way, it's not about waiting for a miracle. It's about planning for both scenarios, and that's what we help clients do here at Pilot every single day. Let me explain.